Hello everyone, this is Dr. Radvi and let us understand the trading rules and regulations in stock exchanges. Stock exchanges are places where the existing shares are traded between the shareholders who are holding them. This is a way in which liquidity is provided to the existing shares which have already been issued by a company. Let us look at the trading rules and regulations. There are three parts of trading rules and regulations. The very first part is known as margins. The second one is known as intraday trading, and the third one is known as exposures. Now, these rules and regulations are pertaining to these three areas because they minimize the risk which are taken by the brokers and prevent insider trading which are done by the parties. Let us understand what are margins. These are the different types of margins which are levied in a particular stock exchange in any particular given trading day. A trading day is basically on a day where the trading activities are being undertaken in the stock market. Now, let us see each of the margins. The very first margin that we will understand is known as a daily margin. They are levied by the stock exchange on the brokers to undertake transactions daily. These margins are basically allowing the particular investor through the trader to take a leverage on his position. Say, let us take an example. A broker wants to trade for rupees 1 lakh. Then, as per the previous day's movement on the stock exchange, the margin would be decided as certain percentage. Let us assume that to be 10%. At the beginning of the day's trade, a broker has to deposit this with the stock exchange and then he can trade for that particular day. For example, in our case, because the broker wants to trade for rupees 1 lakh and the margin decided is 10%, so he would be depositing 10,000 rupees with the exchange. Now, how does this broker come to the figure of 1 lakh rupees? His clients would be expressing a interest that they want to trade or undertake a trade of rupees 1 lakh. In turn, what the broker does is that because he's the one who is placing the trade on the stock exchange on behalf of his broker, he's the one who is supposed to deposit this particular margin. He passes on this margin to his own clients. That is, this 10,000 rupees is not from his own pocket, but he is collecting this 10,000 rupees from each of the share of the client that is under him. Now let us move ahead to the second type of margin. It is known as mark to market margin. These are levied by the stock exchange at the end of the trading day. Opening and closing prices would be taken into consideration. The profit and loss that is earned by the investor would also be taken into consideration. Now let us continue with the above example. What we saw is that initially, as a particular client or as a particular broker, I was supposed to pay rupees 10,000 rupees to the stock exchange. Now let us say during the trading, I suffer a loss of rupees 2,000. At the end, how much would be returned back to him? At the end of the day, the investor would be receiving 10,000 rupees that he deposited as margin minus the loss that he suffered, that is 2,000 rupees, and 8,000 rupees would be returned back to him. If a reverse scenario persists, let us say that I make a profit of 2,000 rupees, then instead of deducting this 2,000 rupees from my account, they would be returning me 12,000 rupees. 10,000 rupees was the initial margin that I deposited, and plus 2,000 rupees, which was the profit that I made. So this profit is added back in case if I make a profit, and loss would be deducted from the initial margin that I deposited if I make a loss. Moving ahead, let us see what is ad hoc margin. Ad hoc margins are charged during the day if the trader exceeds his positions or starts to take more risk than what is allowed. Say, for example, I deposited 10,000 rupees and I am allowed now to undertake trades of rupees 1 lakh. In case if I want to exceed this 1 lakh rupees and I want to place more orders, then I am supposed to deposit more margin as well. So I want to take a risk now. Let's say I want to make an additional investment of 20,000 more. So I have to deposit 20,000 into 10%. That is, I have to deposit additional 2,000 rupees as margin. This additional 2,000 rupees is known as ad hoc margin. This is done because the risk perception of the particular investor is changing and he has invested more than what he had intended. So in order to caution him that he is exceeding his risk percentages and perceptions that he was initially having, ad hoc margins are charged from. The last type of margin is considered to be as a volatility margin. It is charged if during the day when the share in which the investor invests starts to become more and more volatile. By charging such margins, stock exchanges try to prevent the traders and investors from trading in shares which have become volatile and thereby bring the level of volatility down. So they are trying to deter the investors from entering into those shares and those securities where the margin levels are very high. So this is a caution that the stock exchange tries to give to the investor, that avoid going into those markets where risk factor is more, because you will have to pay more margins and there is a very high chance that there is a resultant loss because of this. So your margin that you have deposited, like in our example, we deposited 10,000 rupees. If I start to invest in more volatile markets or more volatile shares, what happens is that I have a risk of losing this initial margin that I deposited. That is, I have a risk of losing the 10,000 rupees that I have deposited with the stock exchange. Now, all these margins would vary from operator to operator depending on the positions that they are taking and the risk that they are having. Further, in case if there is a breach of exposure limit by any party, the trading for that operator is immediately halted and would be resumed only when additional requirements are fulfilled. So there would be a pop-up which says that you don't have additional funds, or you don't have the margins which are required to undertake a particular trade. So as soon as I deposit additional funds, this particular trade can be undertaken. Now, how are the limits decided? For us, it is depending on the script that we are entering. On the other hand, for a broker, it is decided, pre-decided, that how much risk he can take. So let's take an example. There is a broker A under whom there are 10,000 clients. For the clients, the limit would be decided according to the share that he is trying to enter. On the other hand, for a broker, the limit is 20 times his capital. So his capital, let's say, is of 1 crore rupees. Then he can take a risk up to 20 crore rupees. That is 1 crore into 20 times. That is how much risk a broker can take. And due to this reason, he is able to pass on this leverage to the investors or the clients that he is having. Now, moving ahead, let us understand the trading systems in the stock exchanges. There are two different types of major systems which are there. The very first system is known as a order driven system. Order driven system means, like, I place an order and the orders are placed from all over the India. They are entered into electronic system. Then there is a matching which is done on the basis of a time and price priority basis. And then this order matching is done without human intervention. The first order for buy will be matched with the first order for sell. So it is not like that I can pick someone in between and I can match the particular order. Two different things have to be taken into account. The very first thing is that what is the price at which the quotation has been done, or what is the price at which the order has been placed. The second one is at what time the order is getting placed. So a older order is matched with a newer order. Once a matching order is found, the order becomes successful and the transaction or a trade gets executed. The second type of system is known as a quote driven system. So in between there is one particular person known as a market maker. What this market maker's role is, that I as an investor want to buy a security. Someone as a investor also wants to sell a security. This market maker acts as an intermediary in between us, and what he does is that he would be taking the shares from the seller and transferring it to me as a buyer. So instead of having or approaching a broker directly, I can also do this particular type of activity wherein I approach a broker, and he, through his contacts, would be able to find out who is willing to sell and who is willing to buy. This system is less prevalent in Indian stock exchanges. Now, which system is there on which particular exchange? There are two major stock exchanges in India. One is Bombay Stock Exchange, also known as BSE. The index of it is Sensex. And there is NSE, which is National Stock Exchange, the index of which is known as Nifty. BSE functions on order and quote driven system, while NSE is a purely order driven system. NSE it was the very first stock exchange in India which initiated online screen-based trading. Here, human interventions are minimum, and everything is done by using softwares and algorithms, and orders are matched automatically as and when the orders are placed on the market. There are two different types of orders which are placed on a particular stock exchange. The very first one is known as a limit order. A limit order, like the name suggests, that I specify a limit. So I specify the price and the order gets executed only on that price. Retail investors and fund houses use it in order to manage their risk, because market order, on the other hand, is placed at the current price. Okay, as a result, what happens, I as an investor lose the control of how much investment I have to make, or how much risk management techniques I have to undertake. The second type of order, like I said, is known as a market order. A market order is executed at the latest quoted bid and offer price on the trading screen. So if I'm placing a limit order, I get to decide what should be the price. I get to decide how, whether I need to execute the particular transaction now, or I don't want to execute the contract. I don't want to execute the order. I have full control in case of a limit order. I lose this particular control when I'm placing a market order and I'm saying whatever the market is deciding, I accept that particular price. So these are the two different types of orders. At any given stage, any passive order is always matched against an active order. Different transaction fees is charged for the active orders and passive orders. Why? Because the time at which the order is getting entered matters in order to calculate the transaction fees. So this is how the activities and the trading systems on a stock market function, and these are the few rules and regulations which have to be kept in mind of a particular investor while they are entering into the stock exchange. Thank you for joining me to understand the trading systems, rules and regulations of the stock exchanges in India. We will meet again.